Welcome back to the deep dive. Today we're tackling something that, let's be honest, sounds a bit intimidating maybe. Asset dispositions for tax purposes. But trust me, buried in the IRS speak, there's some really fascinating stuff. Stuff that can actually save you money.
That's right. It's
Oh.
about way more than just, selling stock or your house.
Exactly. We're talking trades, foreclosures, even gifting property.
Yeah, and the IRS has rules for all of it.
So our mission today: cut through that jargon, figure out the main categories, and really zero in on how these dispositions affect your tax bill. And maybe find some savings or deferrals along the way.
Definitely. We're using IRS publication 544 for 2024 returns
Hmm.
as our guide. It's kind
Okay.
of the rule book here.
So not just what happened with your property, but why it matters for your taxes.
Precisely. Understanding the why is key to making smart moves.
Okay, let's dive in. Segment 1, the basics. What does disposition even mean in IRS terms? It sounds kind of broad.
It is pretty broad, actually.
Yeah.
Publication 544 lists things like obviously selling property,
Yeah.
but also exchanging property for other property, condemnation, or even the threat of it,
Okay.
repossession,
Yeah.
abandoning property, even giving it away as a gift. All those count as dispositions.
Wow. Okay. So quite a few ways to trigger this. Once one of these happens, how do you figure out the gain or loss? Is there like a formula?
There's a fundamental formula. It's amount realized minus adjusted basis equals your gain or loss.
Amount realized minus adjusted basis. Got it. Let's break those down. Amount realized. Is that just the cash I get?
Good question. No, it's usually more than just the cash. It's the total of all money received plus the fair market value, the FMV, of any property or services you get back in the deal.
Okay, so cash plus other stuff.
And this is important and often missed. It also includes any of your liabilities that the buyer takes over. Think mortgages or real estate taxes they agree to pay for you.
Oh, interesting. So if they take over my mortgage, that counts as part of my amount realized.
Exactly. Let's use the example from the pub. Say you sell a building. You get $100,000 cash, maybe some other property worth $20,000, and the buyer takes on your $17,000 mortgage and pays $3,000 in back taxes you owed.
Okay.
That all adds up to $140,000. Then you subtract your selling expenses, let's say $4,000 in commissions. So your amount realized is actually $136,000. See, much more than just the cash.
Right, okay. That $136,000 is the first part of the equation. What about the other side, adjusted basis? What's that?
Adjusted basis is basically your investment in the property for tax purposes.
Yeah.
It starts with your original cost, or if you inherited it, usually it's value for estate tax
What was
purposes.
that in point?
Right. Then you increase that basis for certain things, like capital improvements, think a new roof or a major addition, something lasting more than a year.
Things that add value.
Exactly. And you decrease it for things like depreciation deductions you've taken over the years, or maybe casualty losses you deducted previously.
Okay, so basis goes up and down over time.
Correct. Using that same building example,
Mm-hmm.
maybe it cost you $70,000 originally. You put in $20,000 worth of improvements, but you've also claimed $10,000 in depreciation.
So 70 plus 20 minus 10.
Gives you an adjusted basis of $80,000.
Got it. So in our example, amount realized was $136,000. Adjusted basis is $80,000.
Which means you have a gain of $56,000.
136K, 80K.
Okay, the calculation makes sense. But the big question then is, what does that $56,000 gain mean for my tax return? Is it always taxable? And what about losses? Are they always deductible?
Generally, yes, that realized gain is recognized, meaning it's taxable. And losses are often deductible. But here's a huge caveat, maybe the most important one for many listeners.
Go.
Losses from selling or disposing of property held for personal use are generally not deductible.
Wait, really? Like my personal car or my main home?
Exactly. Your primary residence, your family car, furniture. If you sell it at a loss, you usually can't deduct that loss on your tax return. The only exception is really for casualty or theft losses. Wow. Okay, that's massive. I bet a lot of people assume they can deduct a loss if they sell their house for less than they paid.
It's a very common misconception. It really highlights this crucial split in how the IRS views property. Is it for personal use, or is it for business or investment?
Which sounds like it leads us right into our next topic.
Yeah.
The difference between capital assets and non-capital assets.
Exactly. This distinction is absolutely vital because it determines how your gains and losses are taxed. It can make a huge difference to your bottom line.
So what makes something a capital asset?
Generally, capital assets are things you own for personal use or investment. Think your home, your personal car, furniture, collectibles like stamps or art.
Okay.
Also investment property like stocks, bonds, cryptocurrency, gold, that kind of thing. Timber grown on your home property or investment land also counts.
And the rule for these is gain is capital gain, but loss on the personal use ones isn't deductible, like we just said.
Precisely. Now, non-capital assets are typically things used in your trade or business.
Like equipment for my business.
Right. Or inventory you hold for sale to customers, copyrights, or compositions you created yourself, accounts receivable from your business. These generate ordinary income or loss, or sometimes what's called Section 1231 gain or loss, which has its own set of rules but can sometimes be treated favorably.
Okay, so it really boils down to the use of the property, personal investment versus business inventory. How does this actually hit my wallet? You mentioned tax rates.
This is where it gets really interesting from a planning perspective. Long-term capital gains, its gains on capital assets you've held for more than a year, are generally taxed at lower rates than ordinary income.
Lower rates are good. How much lower?
Well, current long-term capital gains rates top out at 20% for most people, though it can be 0% or 15% depending on your overall taxable income. Compare that to ordinary income tax rates, which can go up to 37%.
Wow, that's a huge potential difference. So knowing if your asset is capital or not is key to knowing your tax rate.
Absolutely. And it opens the door to thinking strategically about how you hold and dispose of assets to potentially get that lower capital gains treatment.
Which brings us perfectly to segment 3, tax saving and deferral strategies. This is what everyone wants to know, right? How can we use these rules legally to minimize the tax hit or maybe postpone it?
Right. And one of the most powerful tools, especially in real estate, is the non-taxable exchange, often called a like-kind exchange or a 1031 exchange.
Like kind exchange, I've heard of that. How does it work?
The basic idea is this.
Right.
If you exchange real property that you hold for business use or investment solely for other real property that's also like-kind and held for business or investment, you generally don't recognize any gain or loss right away.
So you defer the tax. You don't pay it now.
Exactly. The tax on the gain is deferred. It's not eliminated, but you postpone paying it until you eventually sell that new property you received in the exchange. It's a huge benefit for real estate investors looking to trade up or reposition their portfolios without triggering immediate tax.
Okay, like kind real property. Does that mean I have to trade an apartment building for another apartment building?
No, it's actually quite flexible for real estate. Like kind refers more to the nature or character of the property, not its grade or quality. So you could exchange, say, a rental house for vacant land held for investment,
Oh, yeah.
or city property for farm property, improved land for unimproved land. Even a long-term leasehold of 30 years or more can qualify as like-kind to owning property outright.
That's surprisingly broad. Any major catches?
One big one. U.S. real property and foreign real property are generally not considered like-kind, except there's an exception if you're replacing property that was condemned.
Gotcha. And these exchanges, they sound like they need to happen pretty quickly. Are there deadlines?
Yes, very strict deadlines for what are called deferred exchanges, which are the most common type. You don't swap deeds on the same day.
Right.
First, the identification requirement. You have to identify the potential replacement property or properties in writing within 45 days after you transfer your original property.
45 days. Okay, not much time.
Not much at all. Then the receipt requirement. You have to actually receive the replacement property by the earlier of two dates. Either 180 days after you transferred your original property or the due date of your tax return for that year, including extensions.
180 days or your tax deadline, whichever comes first. Tight timelines.
Very tight. You need good planning and usually a qualified intermediary to handle the funds.
Okay, but what if the exchange isn't perfect? Like, what if the properties aren't exactly equal in value and I get some cash back or maybe some other non-real estate property?
Oh, that happens often. That introduces what the IRS calls boot. Boot is any cash or non-like-kind property received in the exchange.
Good. Okay.
If you receive boot in an exchange where you have a realized gain, you do have to recognize, meaning pay tax on that gain, but only up to the amount of the boot you received.
So it becomes partially taxable?
Exactly. It's a partially non-taxable exchange. Let's use the pub's example again. You exchange investment property with a basis of $80,000 for similar property worth $100,000, plus you get $10,000 in cash. Let's say you had $5,000 in exchange expenses.
Okay.
Your total realized gain is $25,000. Amount realized of $110K minus basis of $80K, less the 5 expenses doesn't factor into realized gain calc but reduces boot. But the cash boot you received was $10,000. You can offset that boot with your $5,000 exchange expenses. So your net boot is $5,000.
So I only pay tax on $5,000 of the gain now.
That's right. Only $5,000 of your $25,000 gain is recognized and taxed currently. The other $20,000 is deferred. It reduces the basis of your new property.
That's still a pretty good deal compared to paying tax on the whole $25,000. Now, you mentioned tricky areas. What about doing these exchanges with, say, my brother or a company I control? Are there special rules?
Oh, yes. The IRS is wise to potential shenanigans there. There are special rules for related persons. Think immediate family members, corporations you control, partnerships you control.
That's the rule.
If you do a like-kind exchange with a related person, and then either of you disposes of the property you received within 2 years of the exchange, then the original exchange gets disqualified from non-recognition treatment. Basically, the tax you deferred becomes due immediately, retroactive to the date of that second disposition.
Ouch. So, no quick flips between family members to avoid tax. Good to know.
It prevents using the rule simply to cash out without paying tax via a related party.
Okay, moving on from exchanges. What about when something bad happens, like a fire, theft, or the government condemning my property? That's an involuntary conversion, right?
Yeah.
Any tax breaks there?
Yes, absolutely. If your property is destroyed, stolen, condemned, or disposed of under threat of condemnation, and you receive insurance money or a condemnation award, you might have a gain.
Right, if the payout is more than your basis.
Correct. But you can often elect to postpone reporting that gain if you reinvest the proceeds into qualified replacement property within a specific time frame.
What counts as replacement property? Does it have to be identical?
Generally, it has to be similar or related in service or use to the property that was converted. But there's a helpful rule for business or investment real property that's condemned. Like-kind property also qualifies as replacement property, so that gives you more flexibility, similar to the 1031 rules.
And the time frame for replacing it?
Usually you have 2 years after the end of the first tax year in which you realize any part of the gain.
2 years from the end of the year, you get the money, basically.
Right. But it's 3 years for condemned business or investment real property. And even better, if it's your main home destroyed in a federally declared disaster area, you get 4 years to replace it.
4 years. Wow. And you mentioned something about main homes earlier.
Yes. This is a fantastic benefit. If your main home is condemned, you can often use the home sale exclusion, first up to $250,000 gain exclusion, or $500,000 if married filing jointly.
Exclude the gain first.
And then, if there's still gain left over after that exclusion, you can postpone reporting that remaining gain by buying qualified replacement property under the involuntary conversion rules.
That's like getting 2 tax benefits for the same event.
It can be, yes. A very helpful rule for homeowners facing condemnation.
Okay, switching gears slightly. What about giving property away? Specifically, what if I sell property to a charity for less than it's worth? A bargain sale. How does that work tax-wise?
Bargain sales to charity. These are treated as part sale, part gift. You might still have a taxable gain, even if you sell it for less than your total basis.
How can you have a gain if you sell it for less than you paid?
Because you have to allocate your basis. If you get a charitable deduction for the gift portion, you have to split your property's adjusted basis between the part you sold and the part you donated, based on fair market value.
Okay, example time.
Sure. Let's say you have property with a FMV of $10,000 and your adjusted basis is $4,000. You sell it to a charity for $2,000.
So you're donating $8,000 of value?
Right. The sale price, $2,000, is 20% of the FMV, $10,000. So you allocate 20% of your basis to the sale part. 20% of $4,000 is $800.
So the basis for the sale part is only $800.
Exactly. So you have a gain of $1,200, $2,000 sale price, minus $800 allocated basis.
Yeah.
Even though you sold it for way less than your $4,000 total basis.
That's counterintuitive, but makes sense when you break it down. Basis allocation is key.
It is. And the remaining basis, $3,200 in this case, is allocated to the gift portion for figuring your charitable deduction, subject to other deduction rules.
Okay. One more specific type before we talk reporting. Qualified small business stock, QSBS. Sounds niche, but potentially powerful.
Very powerful for the right situation. QSBS rules are designed to encourage investment in certain small, active C corporations.
What's the benefit?
2 main benefits. First, if you hold QSBS for more than 6 months and sell it at a gain, you might be able to roll over that gain tax-free into other QSBS as long as you buy the replacement stock within 60 days.
A rollover like the like-kind exchange.
Similar concept, yeah.
Yeah.
But the bigger deal is the exclusion. If you hold QSBS for more than 5 years, you may be able to exclude a significant portion or potentially all of the gain from your income. The exclusion amount, 50%, 75%, or 100%, depends on when you originally acquired the stock. 100% exclusion applies to stock acquired after September 27, 2010.
Exclude all the gain. That's incredible.
It's a massive incentive. There are lots of rules about what qualifies as QSBS, but for investors and startups and small businesses, it's definitely something to be aware of.
Okay, fantastic rundown of the different types and strategies. Now, segment 4. Let's get practical. How do we actually report all this stuff to the IRS? What forms do we need?
Right, the paperwork. The main players for reporting these dispositions are usually Form 89949, Schedule D, Form 1040, and Form 4797.
Okay, Form 8949. What goes there?
Form 8949, Sales and Other Dispositions of Capital Assets, is where you list the details of most of your capital asset sales and exchanges. Think stocks, bonds, crypto, maybe investment real estate if it's not reported elsewhere.
So individual transactions.
Yep. You list the description, dates acquired and sold, proceeds, cost basis, and calculate the gain or loss for each one. It also handles things like worthlessness of securities and non-business bad debts. And your QSBS gain exclusion or rollover is reported here too.
And then that feeds into Schedule D?
Exactly. The totals from Form 8949 flow on to Schedule D, Form 1040, capital gains and losses. Schedule D summarizes everything and calculates your net short-term and long-term capital gain or loss.
And that's where the holding period really comes into play, right? Short-term versus long-term.
Correct. Schedule D separates gains and losses based on whether you held the asset for 1 year or less, short-term, or more than 1 year, long-term. Remember, long-term gains usually get those preferential tax rates.
And how do you count the holding period? Is it from the exact day?
Good question. You start counting the day after you acquire the property up to and including the day you dispose of it. So buy in Jan 1, sell on Jan 1 the next year, that's exactly 1 year short term. Sell on Jan 2 the next year, that's long term.
Okay, day after you buy. Got it. What if I end up with more capital losses than gains on Schedule D?
If you have a net capital loss, you can deduct up to $3,000 of that loss against your ordinary income each year. $1,500 if married filing separately.
Only $3,000? What if my loss is bigger?
Any loss above that $3,000 limit isn't lost forever. It gets carried over to future tax years. You could use it to offset capital gains in those future years, and again, deduct up to $3,000 per year against ordinary income until the loss is used up. It keeps its character as short-term or long-term, too.
Okay, so the loss carries forward. That's good. Now, what about Form 4797? When do we use that one?
Form 4797, Sales of Business Property, is primarily for, well, business property. This includes sales or exchanges of real property or depreciable property used in your trade or business.
Like the building or equipment we mentioned earlier.
Exactly. It also handles involuntary conversions of business property, other than casualty theft, and dispositions of non-capital assets. And crucially, Form 4797 is where you deal with depreciation recapture.
Ah, yes. Depreciation recapture. Sounds like something we want to avoid. Explain that again. Why is it such a big deal?
It's a big deal because it can turn what looked like a nice lower tax capital gain, or Section 1231 gain, into higher taxed ordinary income.
Cow.
Remember how you deduct depreciation on business assets over time? That reduces your tax bill each year. Recapture is basically the IRS saying, okay, when you sell that asset for a gain, you have to pay back some of that tax benefit you got from depreciation.
Pay it back by taxing the gain at higher rates.
Essentially, yes.
Yeah.
The portion of your gain that's due to the depreciation you previously took might be reclassified from capital gain to ordinary income.
Are there different rules for different types of property?
Yes. For Section 1245, property, generally tangible personal property used in business, like machinery, equipment, vehicles, the recapture rule is harsh. Any gain up to the total amount of depreciation you've ever taken on that asset is treated as ordinary income.
Oof, all the depreciation.
Pretty much. For Section 1250 property, which is generally depreciable real property, like buildings, the rule is usually a bit gentler. Recapture typically only applies to additional depreciation, meaning depreciation you claim that was more than what straight-line depreciation would have been.
So if I just use straight-line depreciation on my building, I might not have much Section 1250 recapture.
Often, yes. Though there's another catch for buildings called unrecaptured Section 1250 gain, which is taxed at a special rate, currently capped at 25%. But that's a detail for another time, perhaps. The main point is depreciation recapture can significantly increase the tax on the sale of business assets, and it's calculated on Form 4797.
Wow. Okay, that covers a lot of ground. From basic definitions to complex strategies like kind exchanges and QSBS, and finally, how to report it all, including that tricky recapture.
It really shows that selling or disposing of property isn't always straightforward from a tax perspective. Understanding these rules bases, amount realized, capital versus ordinary, the deferral options. It's not just about filing correctly.
It's about planning, right?
Exactly. It's about strategic planning. Knowing you might be able to do a like-kind exchange instead of a simple sale, or understanding the implications of QSBS, or how depreciation affects your eventual tax bill, that knowledge is power. It lets you structure things to your advantage legally.
So when you look at your assets, maybe don't just see a building or stock certificate. See the tax implications, the potential obligations, but also the opportunities.
That's the perfect takeaway. Are you just seeing the asset, or are you seeing its potential within your overall financial and tax plan? Planning ahead for dispositions can make a huge difference.
Fantastic insights today. Thanks for breaking down Publication 544 for us.
My pleasure. It's complex, but hopefully this makes it a bit more navigable.
Definitely. And thanks to all of you for joining us on the deep dive. Keep sending in those sources, and we'll tackle another topic soon.